Doing okay. How about you?
Good. All right. So I'm live now on Facebook, YouTube, LinkedIn. Hey, everyone. I'm just getting going for the radio show right now. I am ready to go.
Sebastian.
I'm just setting everything up quickly.
Can you hear me?
All right. I'm setting the 11 minutes.
And ask him when we should start.
Yep, 11 minutes on the first segment.
Yep. And then 10 minutes on the next. When I hear the music or.
When you let the music play for about 10 seconds, and then walk in.
Okay. So David says let the music play for 10 seconds and then walk in.
Pretty much.
All right. Saunter in.
You got 4 minutes and 45 seconds till we start.
Oh. Okay. I've got 4 minutes and 45 seconds. Is this going to be the usual that we start at like 5 after 9?
Yeah, because right now they're playing ABC.
It's more around 9:07, but yeah, roughly.
Oh, okay.
Three stations.
All right. So here's what I'm going to do. I'm on. All right. So this way, because I have people in, Facebook Live and other stuff. So I see Stacy's out there. Thank you, Stacy. So what I'll do from now on is I won't go on to my live on Facebook until like 9:05.
I'll give you a countdown when we have like a minute remaining and stuff, and then 10 seconds remaining, all that,
Okay. Cool.
which we do have 4 minutes remaining.
Okay. So all right. So I see Stacy's out there. Thank you, Stacy. You've been like such a great supporter and friend since day one. I really appreciate it. Thank you so much. We're going to talk about cyclical versus defensive in terms of stocks. A couple of little points about contribution limits this year for the gift tax exclusion, IRAs, 401k. Yesterday, I'll just reiterate, we spoke about preparing for a recession if you feel you are facing some job security. Okay. I think I might bring up, like, if you're facing job security and you're over 50. I keep looking over here.
3 minutes remaining.
David is here. Okay. 3 minutes remaining. David, my producer, is next to me. He's sitting next to me, coming in from the studio, because they allowed me to do this for my office. I have the whole setup. I've got my awesome equipment and all that. So he's babysitting me, holding my hand, making sure the first couple of days I get off to a good start and I know what I'm doing. Okay, he's holding my hand. You see that? Okay, thank you. So that was funny. So that's why I keep looking over here, because David's right there. I could literally just about, if I lean over a little bit, I could give him a pat in the shoulder. All right, there we go. Gave him a good pat in the shoulder. I almost said I'm close enough to smack him, but who would, he's the nicest guy and he's adorable. Plus he smacks back, so can't do that. So this came up on my phone.
2 minutes remain.
Okay, there's a picture of my dog when he was a little puppy. All right. I hope that made your day. Benji, he's going to be 2 in May. He's a Cavapoo. Yeah. Sebastiano's keeping me updated. He gave me the 2-minute mark about 35 seconds ago.
Right.
I'm going to take a quick trip to the bathroom now. All right, Sebastiano?
Gotcha. You have 1:30.
All right. I'm kidding. I'm joking.
Okay, yeah. You gotta go to number 2.
As soon as I said, he's like, you got 1:30. Actually, Sebastiano is very calm. He's mission control. Sebastiano is the fellow in the mission control at the studio, who tells you how much time you have, puts the music through, tells you when you're getting off, and basically produces it. Hello, world. All right, so
Minute remains.
All right, so next time I hit the live button on social, I'm gonna wait till probably like 9:06 to do that. We're a little bit early. I didn't realize they go through like the whole CBS News and reports and all that.
ABC.
Oh, ABC News. Okay, excuse me, ABC News, and they do all that.
You were following ABC News.
And I follow ABC News, which is pretty cool.
30 seconds.
The radio feed through Facebook.
Mhm.
Do they hear the music on the radio feed?
Yeah.
Facebook?
Yeah, they hear the whole thing.
20 seconds.
20 seconds. Oh my God, I'm getting nervous. Oh my God.
10 seconds.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
All right. Thank you very much. Here we go. We're getting started. I'm Mitch Goldberg. You're listening to Money in the Morning with Mitch Goldberg. And we've got a couple things to cover. First, I want to thank ABC News for the quick update. That's always greatly appreciated. Thank you, ABC News. I also want to say to you, the audience, thank you so much for giving me a chance. I hope I bring value to you. That's the whole goal, just to bring value to you. I know a lot of you were listeners to another show, Brian Kilmeade. We made some changes at the station, and now I'm here at this time. And I really appreciate your giving me the chance, the opportunity to brighten your day and teach you a whole heck of a lot about investing and borrowing and leasing cars and insurance and all that good stuff. It's really important stuff. So I greatly appreciate you giving me a chance here, and it's nothing but value. And if you want quick hits, snippets, that sort of thing about personal finance, investing, check me out on Instagram. I'm at InstaMitchG on Instagram, and on YouTube, I'm Client First Strategy. And I post a ton, just a crap ton of content, video snippets. It's pretty much daily. So I've always got some tips to share, and these are like, 1 minute videos that give you a good quick tip. And sometimes you'll even be like, wow, I never really knew that. I never thought of that. So good Tuesday morning to you. This is my second ever live show of Money in the Morning with Mitch Goldberg, and you're listening to 103.9 FM LI News. So let's get started. Couple things. Yesterday, we spoke about preparing, if you have job security, about preparing for a recession, just the three things: emergency fund and or drastically cut expenses if you're concerned about it. Another one is start networking, especially on LinkedIn. Don't be invisible. Update your LinkedIn profile, put a nice picture, etc. We could get into that whole thing about how to use LinkedIn. I am an expert with LinkedIn, and I could bring a guest on who's a total expert on LinkedIn if you'd like. Let us know on the Facebook page of LI News what you think of that. If that's something you want, a whole thing on LinkedIn, please let us know. And if you have any comments or questions, that's what the LI News Facebook page is for. We love hearing from you. It's actually the best part for everybody who's on radio, just, to hear from the audience. So let's make sure we do that. We'd greatly appreciate that. And the other thing I said is maybe take a class, get some kind of certificate, put that on your LinkedIn profile, your resume. Employers want to know that you're still out there learning new skills, that you're an active learner, that your mind is flexible enough to keep learning. I know that's important for me, being someone who is over the age of 50. I'm 55. We worry about that sort of thing. Some of us, age discrimination, it's called. So show people that you are a lifelong learner and you're flexible of mind to earn new certificates and skills. And I think that would go a long way. So I hope you agree with that. If you don't, then, one day you might agree with it. Okay. What I want to do is talk about a couple of things. Investors are continuing to enjoy a phenomenal rebound, and last year's big losers, in particular, the tech sector, from semiconductors, web-based internet companies, software. So that continues. How long that continues is anybody's guess. If we do go into a cyclical recession or just a major slowdown, that does affect software and semiconductor sales. So a lot of these companies are coming in with lowered earnings, but on lowered expectations, rebounding off of substantial drops. We'll see if they get to a level where they are actually can keep going. It's really tough to know at this point. So the Dow futures are down 163, S&P futures down 21, Nasdaq futures down 0.75. Oil is up 81.85, and the 10-year yield is hovering about where it was yesterday, 3.51%, just off a tick. No big deal. So, by the way, when I talk about the futures in the morning, whenever you hear about the futures, the Dow futures, the S&P futures, that doesn't mean that's how the whole day ends up. So many times we've had futures that are very positive in the morning, and by the end of the trading day, the markets are down, and vice versa. They're just an indication that tells you more or less what the open is going to be like. And by about 9:35 a.m., it's not really that big of a deal. But I think it just, I look at it because it helps me get my day started in the right frame of mind. Okay, so that's that. I also want to talk to you about cyclical versus defensive. This is a very common these are very common terms in investing. I say common because I speak this language every day, but you might not speak this language every day. And I want to make sure we're all on the same page, and I'm just here to educate you. So cyclical stocks are stocks that are sensitive to the economy. So if the economy is doing well, stocks that are like smokestack stocks, industrial stocks, companies that make things that if you drop them on your foot, it's going to hurt. Okay. So cyclical companies include companies like a Caterpillar, a John Deere, any kind of machinery company, transportation company. Okay. Stocks in these sectors, that's cyclical. And if you believe the economy is going to strengthen and stay strong, cyclical stocks could be a very good place to be. Could be a very solid place to be. Get it solid because they make usually solid things, right? Okay. Yeah, that was a bad attempt at some financial humor. So that's what cyclical stocks do. And then you get into defensive stocks. And when I say defensive stocks, I don't mean defense companies like Northrop Grumman or Raytheon. Okay. I'm talking defensive in nature companies whose earnings and revenues typically hold up well during economic weakness or a recession. And that could be companies that sell toothpaste, toilet paper, and packaged food companies. So you take a look at a Procter & Gamble, a company like Mondelez who makes Oreos, for example, Pepsi, Coca-Cola. Those are defensive in nature. And they typically see a rush of investor money, or at least investor attraction, when it's expected that the economy could get weak. So there are investors who like to move around between cyclical stocks and defensive stocks. I don't personally condone it for myself. I can't speak for everyone, but for myself, I don't like to just flip my entire portfolio, my retirement plan and all that from cyclical to defensive and back and forth, because sometimes when you expect cyclical stocks to keep going up, people start to forecast an economic slowdown, Fed rate hikes. If inflation goes up, people start to forecast the Fed raising rates. And then cyclical stocks start to go down even while the economy is still strong, and defensive stocks start to go up. So these moves between cyclical and defensive, they happen early in advance. So I think the key is to be diversified and own both for most of you. Now, diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market like the one we've been in for the last year. Having said that, if you know what cyclical stocks are and defensive stocks and how they work, it gives you a much greater understanding in how the stock market works. And that's something I really talk about a lot, is how the stock market works. And I want you to know how the stock market works. I want you to know this very badly, because people make emotional decisions, investing decisions based on what they see now. And quite often the best thing to do for an investor is actually to do nothing. Just let things take their time. Let things ride out. I like to say markets, the averages have always recovered. Always. And that's why when you hear somebody say, oh, don't worry, the market always comes back. Yes, I agree with that. And I condone that. And I say that. But if somebody's in a lot of individual stocks and they have stocks that are down like 60, 70, 80%, they look at me like I have two heads because individual stocks don't always come back. And that's how I explain the difference between investing in something like an index fund that tracks a broad average like the S&P 500 or an individual stock. You're taking a different set of risks. One could give you more upside, but that also could give you a lot more downside. And that's why I think for a lot of people, individual stocks aren't necessarily the best thing for them. Okay, by the way, you can't invest directly into an index, but you could invest into a stock or some security that tracks an index. I hope this is helpful. If you have any comments or questions about this, definitely ask us in our LI News Facebook page. And if you don't follow us on Facebook, please do so right now. And we love to hear from you. We love to hear your comments. And we're there, LI News is posting stuff there all the time. They're posting events. They're posting about their advertisers. They're posting about their upcoming shows. So it's definitely a good place to stay. You hear the music. We're going to tune out for a moment for some commercials. And please stick around. We've got more to cover. This is 103.9 FM, LI News Radio.
All right, put 10 minutes on the clock, and you got 1:45 left. You there?
I'm here.
Awesome.
I'm just putting 10 minutes on the clock.
Gotcha.
Yeah. Right.
There's nothing wrong with that. No one else can say that on any other program. It's not pitching. You're educated.
1 minute left.
Oh, it's trippy. All right, everybody in Facebook land and LinkedIn land and Twitter land and YouTube land, we are going to continue with the show. We've got another 10 minutes on the clock. We're going to start that
40
in
seconds.
about 40 seconds, as Sebastiano just told me, who's in the control room at the studio. At the studio, we're going to toss it back to you.
If only I could actually do my own segments and stuff. 20 seconds.
ABC News is fun. JL is more important. You can be a guest at the show.
All right, we're back. Commercial interruption is over, and we are back talking to you about personal finance and the stock market and all kinds of things. There's a lot of randomness to my show at the moment, and when I say randomness, I'm not trying to say, well, I'm all over the place. I really want to make sure I'm giving you value, and as I learn more about you, the audience, and what you want, it's going to really help me. It's going to help me hone in on what I should be talking about. So right now, I'm kind of starting as a generalist with you, and then we're going to get into specific things once in a while, like really like niche stuff about investing, about personal finance, and we're going to take deeper dives into more niche topics. Okay, so stick around. This is going to be a fun show, and I want to make it entertaining and, of course, super knowledgeable. So one thing that we talk about a lot is the VIX. Now, that's the volatility index. The VIX is the volatility, or the VIX is called the fear gauge. Now, this is getting a little into the weeds. Most financial shows and news, radio updates, etc. don't talk about the VIX, but I look at the VIX every single day. The fear gauge. The VIX basically expresses what professional money managers, big money, are willing to pay to hedge their portfolio using things like futures and options that they, because they're worried about the market going down. And when you see the VIX spike up a lot, it means the stock market's down a lot because the cost to hedge your portfolio is cheap when the market's going up because the demand for hedging is less. That makes sense, right? But when the markets get rocky, there's some crazy stuff happening in the world. The economy is about to implode. The cost to hedge rises very quickly. And then you see the VIX spike up. Now, the VIX is about 20, which I think is a good level to start talking about the VIX with you. And you'll hear about the VIX a lot more. And I think it's just because you hear about it a lot, it's something that's worthwhile for us to talk about so you know exactly what it is. 20 is a good level where you kind of think that we are more or less evenly balanced between not too complacent and not too worried about the direction of the stock market. So the VIX is about 20, and when it gets to lower than 20, that's when the market, okay, that's when the stock market is, people are worried about the stock market, okay? So let me go back. When the VIX is below 20, that's when there's a feeling of complacency. So as a contrarian, if investors are complacent and they're happy, you could tell because the VIX is low, that's when a lot of investors, especially professionals, will say, I think it's time to take some profits. I have a stock that went from 20 to 50. That's a lot. I'm not worried about the stock going to 100. I think I need to take some profits on that now. And that's more or less how we read the VIX. So when the VIX spikes up to like 60 or 50, which is super, super high, that's when the world is falling apart. That's when investors say, I can't believe I ever invested into this crazy market and wasted all the money that I've accumulated for my entire adult life. I've got to get out. That's when a professional investor would say, it's time for me to buy. Now we go back and forth like this. So the volatility index is just comprised of near-term futures, 30 days and less. That buying futures is like buying options. And if you don't know what that is, these are esoteric investments that you could buy for less money than a stock. No, I really want to explain this the right way. That makes sense. It's basically buying contracts that expire in 30 days, which will protect you or should protect you from the market going in a direction up or down that goes against your positions. Okay, so if you're long the market, meaning you own the market, you own stocks, that means you're long, then you want downside protection if you are looking for that kind of thing. If you're shorting the market, meaning you're betting that stocks go down, you want upside protection. So if the market goes up, you'll lose money. If you're shorting the market, you want some protection if something crazy in the world happens and stocks spike up. This is not for everybody, but it is an important part of the mechanics of how the stock market works. So that's why I sometimes talk about the VIX. I'll explain this again because as new viewers come in, people might not have heard about this, or you might not remember exactly what we're talking about because we could go a while without talking about the VIX. So that's the VIX. Now I want to talk about something else. I want to let you know that there have been some changes this year to retirement plans and gift taxing. Okay, so the gift tax exclusion this year on the federal taxes is $17,000. So that means a married couple could give $34,000 to a child or anyone they want without having to file a gift tax receipt. The person receiving the monetary gift from you does not file taxes for that. You, the grantor, the giver, is the one who has to file taxes for that per person if it's over $17,000 or $34,000 maximum jointly, if you're married filing jointly. Okay, so that's one thing. The 401k maximum contribution for 2023 is $22,500. Some people, people ask me these questions. Hey, what's the maximum? So when people ask me these questions, I just say, this is good content, and I'm bringing it to the radio show. If you're over 50, you can make a catch-up contribution of $7,500 for a maximum 401k contribution of $30,000. Okay, a lot of people don't know that. So $30,000 for an IRA, maximum contribution for a traditional IRA and a Roth IRA is $6,500, $7,500 if you're over 50. Okay, so that's something you should know about. And the other question I get is, could you contribute to a 401k and an IRA in the same year? The answer is yes, up to the maximum limits. But depending on your income, there are limits. You very likely, if you're maxing out a 401k plan, you're probably above a certain threshold of income to be able to write off the contribution to your IRA. So you can still make the contribution and go for the tax deferred growth. Not tax free, it's tax deferred, because you do have to pay taxes on the money when you take the money out of an IRA and a 401k eventually. But you could do both, no problem. It's just a matter of whether or not you get the tax deduction to do so. Okay, it kind of negates the reason to do it, but that's something that people ask me all the time. And just so you know, I'm not a tax advisor. If you have a tax issue, you should definitely speak with your tax professional about your situation. All right. So if you have a specific question, though, you could reach out to me. My website is clientfirststrategy.com, clientfirststrategy.com. And people call all the time asking about rolling over their 401k plan. If they're invested appropriately for their age, they want help determining their risk tolerance. They want to know if they have enough money to retire, or what they should be doing now so they could get ready to retire. These are the kinds of questions that I help people with daily. So if you have like a general question about the economy or the stock market, the LI News Facebook page. But if you want more specific information, you need to reach out to me or your financial advisor, if you have one, with directly with real specific questions. So that is what I wanted to talk about today. We've got a show after me with David Levenstein. What's the name of the show, David? Back to Business. So stick around. We've got Back to Business with David Levenstein coming up. He's going to be interviewing Dr. Atwa from Mather Hospital. And, David always has a way of pulling information out of people that you just didn't expect. So you never know what's going to happen on his show. So you definitely want to tune in and learn a lot about what they're going to talk about healthcare and what Mather Hospital and Northwell and all that have in store for us. So thank you so much for watching. I'll be back tomorrow. We're going to talk about the Secure Act 2.0, and we're getting into the weeds of specific financial things that you can do for your future. Thank you. I'm Mitch Goldberg.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member of FINRA SIPC. Client First Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and Client First Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.
All right. Thank you, everyone in social media land, for sticking with me. I really appreciate it. I'm going to get off the live presentation now, and I'll see you guys tomorrow. Actually, I'll see you guys today at 4:30. Okay. For Be the Boss of Your Money. Have yourselves a great day.